Good afternoon. Welcome to the Business Broadcast. I'm delighted that I have with me Stuart Mullins from Clark's Legal as my guest today. Welcome, Stuart.
Hi, Nikki. Thank you very much for having me today.
So the reason why we're here today is we're talking about EOTs. So we will go through exactly what they are. Stuart's great expert on them because he's done more of them than I know anyone else that's done them. So he is the man to talk about this. But particularly, this is a really good succession planning tool. So if you're wanting to exit your business or exit over a period of time, this could be a really good way to do it by selling it to your employees. And so two reasons why I want to raise this today is one, just not enough people still know about EOTs, which is why we're doing it today. And also, even though people that do know about EOTs, they don't know whether it's relevant to their business and they can use them. So hopefully today, some of those things will be answered. As always, it's going to be an interactive session. So because it's live, so if you're watching this live, please do feel free to pop in the comments a question and say hello. I know that some people, there will be quite a few people watching this on catch up because they're probably still watching the mini budget or fiscal event. So do contact us afterwards as well. But please do post your comments or questions in the comments box so that I can ask Stuart, the guru, on EOTs. So firstly, what everyone wants to know, what's EOT stand for and what is it?
Thanks, Nikki. Yeah, certainly. So I suppose in this context, what we're talking about is employee ownership. And through an EOT, we're talking about employee ownership trusts. And the employee ownership trust is a mechanism whereby sellers of a qualifying interest, and by that I mean all or a majority of the shares, are sold to a trust which exists for the benefit of the employees in that business from time to time. So it's really important when we talk about employee ownership through EOTs that we understand that it's not like a management buyout where the employees are all getting a defined share holding each, for which they'll hold forever and a day. It is a process where, a bit like a pension, where the value of the business is in a trust for a class of beneficiary, which are the employees from time to time, and they, through that trust, will share in a distribution of income, or if there's a disposal of the business or shareholding down the line, and that's in the interest of the employees, perhaps a capital interest as well. They'll generally share in the capital disposal value of the shares if and when that happens in the future.
Okay, so we know now what the EOT is, and it's a mechanism. Who is it for, and how do they benefit? Why would they want to look at it?
Okay, so just by way of outline, if you think you've got shareholders in a business, they will enter into a share purchase agreement, share purchase and sale agreement, that will dispose of their shares to the trust. The trust is run by trustees, and that's generally another company. That company will hold that shareholding for the benefit of those employees. And their primary objective, firstly, is to deal with the payment obligations under the sale and purchase agreement. So their primary obligation is to ensure that the sale and purchase consideration is dealt with. And normally the way in which that agreement works is that the company or the shares are sold for an amount equal to surplus cash in the business on completion, and then the balance of that price is paid through the generation of profits year on year to satisfy the deferred income element.
So essentially, if there was, just to do a little illustrative example, say your business was valued at £1 million, you were selling 60% of it because perhaps you wanted to retain a percentage.
Correct.
If you had surplus cash of 200,000, on the day that you sign it over, 200 of the 600 will be paid, but the rest, the 400,000, will be paid through the future profits.
Correct, and that's really important, and it's through a loan note mechanism, which is generally drafted pretty fluidly because you want to ensure that the company can still trade and has sufficient cash to perform its obligations. You don't want to hamstring the business. I suppose the primary advantage, certainly in the SME sector, is that you can, I suppose, as a headline, decide when you want to dispose of your business. Hitherto, you've been reliant on a management buyout, generally people raising enough money through borrowing or personal wealth to come together and buy the shares from you, or a trade sale. And you and I know that you're generally at the beck and call of a purchaser and demand in the market rather than as a seller trying to plan their succession. I suppose that's one of the advantages. The other advantage is that it's very favourable tax treatment. The sale of the shares that you're disposing of under this structure is tax neutral, and by that I mean you do not pay any tax on the cash.
So no capital gains.
Capital gains neutral. Entrepreneurs relief or business asset relief, as I believe it's now called, isn't applicable because there's no CGT triggering event. So your annual allowance remains untouched. That lifetime 1 million allowance remains untouched. But more holistically, if you've worked hard in your business and you're selling to those stakeholders that can carry the business forward, you've got some sort of legacy certainty around it. You know that the business is in safe hands, whereas perhaps if you sold it through a trade to a competitor, you don't know what's going to happen, whether they'll hive the assets out, get rid of the people, and wind the company up. I suppose
we've got a question come through. So excuse me for interrupting for a second. So Nigel asks, hi Stuart, do you think this is more applicable to certain sectors?
No, I think it's quite sector agnostic. Certainly my experience is that it applies to probably a broader range of business than other exit mechanisms. For example, we've seen in recent years high street retailers, professional services firms, legal firms, small engineering practices, IT consultancies, telecoms businesses all proceed through an exit around an EOT structure.
Great. So just I know that we were going to go on something else for a second, but just one thing. So just to be clear, so the value of the sales value, how's that determined?
Yeah. Okay. So as I say, there is favourable tax treatment on disposal through EOT process and structure. There are very clearly defined rules about how that disposal must take place in order to comply with the tax legislation that gives rise to that tax favourable treatment. Now, I'm not a tax advisor or tax specialist, as you know, Nikki, so I can't comment hugely on that. But in terms of valuation, you are obliged, really, for the benefit of the sellers and also the trustees, to get a full valuation. It must be fair or market.
So it is a valuation that has to be done. So it's a market. You can't just go, oh, it's going to be 2 million. You've got to have it as a proper valuation, and then there's clearance on that.
Correct. Absolutely. Every transaction.
You can't just go and say, it's 3 million and cream everything out. It's got to be a proper professional valuation.
That's right, and it needs to be independent, in my view, because And when I say independent, it needs to be done not by the incumbent accountants or auditors. It should be done by an
By
independent
third party.
third party. And the reason for that is that you are presenting this to employees or co-workers who will generally form the directors of the corporate trustee. And that by virtue of their office, they have an obligation to make sure that they are buying the assets, the business, the shares for the benefit of the employees at a fair value. They want to make sure that they, as part of their professional obligations, are confident that the value being paid for is correct.
They need to know that there's confidence in that it can be paid, and there's no point stripping all the money out of the company and then the company go under. And to be fair, that's not fair on either sides, because the employees don't want to be left with a worthless asset, and the sellers want to make sure that they do get their loan notes paid.
And that's right. And of course, under the legislation, that if the process fails, if the business can't afford to pay the obligations, and the trust fails within a period of 5 years, for example, all the favourable tax treatments are reversed. So all parties have an interest to make sure that the rules are complied with, but also that when you're working through the deferred consideration, that you're leaving enough elasticity and fluidity in that loan note structure to make sure that, heaven forbid, we have another pandemic. But as an obvious example, that the business has the ability to flex and make those payments in a favourable process to ensure.
And potentially raise money to pay them as well. It doesn't just have to come from the
well, no, that's I was about to say. I was about to say, in certain instances, it is possible to get bank funding or institutional funding, where the bank will lend the money to accelerate an exit, and may well finance the trust refinance in sort of 2 or 3 years to accelerate an early exit. So certainly, my experience, we have been involved in transactions involving bank debt.
So if there's a business owner out there that's thinking, oh, yes, this is something that I'd like to consider, what should they consider before going ahead?
Yeah, okay. So that's a really good point. I mean, you do have to think about, before you go down this process, whether or not, and undertake some analysis from experienced and qualified advisors to ensure that your business is suitable for an EOT disposal. There are, for example, within the rules, certain exclusions and difficulties that can arise where you've got shares that are held by connected parties, so family members, for example, and therefore you want to undertake that audit early on. You also want to be clear on the clearance processes and the valuation processes. And again, you need to talk to experienced people to just get a feel for that. The other thing is, as I say, with this structure, you are effectively having a trading company, a seller, and a corporate trustee generally, or trustee, which will need a board of trustees or board of directors to run it. You have to give some thought as to, within your business, how who those key protagonists are going to be, what seats they're going to take in the trading business, on the board of trustees / board of directors of a corporate trustee, and how they're going to interact, because we don't want people falling foul of the conflict of interest rules that we all know exist for quite correct reasons.
And each side, of course, both need their relevant advisors. You can't just...
It's absolutely imperative that the trustee, corporate trustee, or the board advising the corporate trustee does take its independent advice. But as I say, it's very much a more holistic approach to dare I say, adversarial sale and purchase structure under a trade or trade team. The due diligence should generally be streamlined, because you are selling effectively akin to an MBO, where you've got key people who know the business. You would put together a pack of the documentation, and you would present that then to your board or trustees, and they would take advice on on the terms of that documentation and make sure that they are confident in understanding their obligations, because they represent the employees, just as any trustee represents any beneficiary.
Yeah. So if we sort of break it down into stages, so correct me if because you've obviously done lots more of these than I've been involved in. And so first of all, the owners have to have a consensus that there needs to be some sort of sales event.
Correct.
They then need to think about how much they want to sell, and there's a minimum percentage that has to be sold.
They do. Under the rules, they have to sell a qualifying interest.
So it's got to be at least 51%.
Now, what my view on that is that usually you would expect somewhere in the region of 70 to 80% being sold.
Oh, okay. Right. So from a practical perspective, better be 70 to 80.
The reason for that is you can put in place share schemes to incentivize core management, senior management within the EOT structure or class of employee generally, and that can exist.
Which would then at a later stage dilute those shares.
Correct. And again, if you fall foul of the 51% controlling interest requirement, that does give rise to a breach of the rules, and for the reasons I've said.
Yes, you've got to plan it out and be very careful with the shareholding percentages, and look at that structure. So that will be that. Then they'll be looking at what the potential valuation could be. So they might, before they instruct the formal one, still might just want to have a general idea. Because actually this fits in with a question, and Nigel's busy today. Another question for Nigel. Is there a certain size of company that this becomes applicable to, with setup costs, etc.? Which is relevant because, there are, even though you've got the no tax on the sale, there is still a certain amount of structural costs and legal fees, etc. So what sort of size would you say? Would you say, I don't know, if the sale was under 200,000, it's not worth doing, or is there sort of a sweet spot?
I mean, there is a director to employee ratio test. But generally, I don't think it's designed for. It's not specifically aimed at very large businesses.
No,
and it is quite possible to do it with businesses of a dozen or so employees. It just depends on the application of the detail of the rules.
So it's a reasonable size SME.
So a reasonable size SME, where you're looking at sort of, disposal value of probably 500,000 and upwards.
Yeah,
but as you say, it's more the way the legislation works is it's about this director ownership ratio. It's about ensuring that it's not really just a purely family-owned business where the directors and the shareholders and there are no other employees exist. It's about ensuring that there is a true, if you like, true employee benefit on disposal. In terms of costs, certainly in my experience, the transaction costs are cheaper, generally, because it's unlikely.
Compared to what?
Than a trade sale, and a conventional share trade sale.
Okay.
Or MBO.
Yeah.
Because the reasons for that is that this isn't a negotiation exercise for the sellers. You are presenting an offer. That offer isn't up for negotiation or discussion. That really is the deal. And of course, the benefit is that the employees and the trust aren't really putting any money of their own into the business. They are getting the benefit effectively as a class of beneficiary without any risk. And there's all sorts of, again, interesting tax benefits. For example, every employee can get a £3,600 a year tax-free bonus at a surplus income and distribution under the rules of the.
And that's annual.
Correct.
Yeah, which people like. Everyone likes something that's tax-free.
So in my experience, they don't object.
Indeed. Even if we haven't got tax-free yet, even though they've been cutting the taxes this morning. So the next thing, I was going through the process, wasn't I? So thought about the potential size, so the potential sale, and then it's thinking about, is there the right management team in place and the right people therefore to go on the board of trustees? You can't just go and land it with your employees. You need to make sure that there is a decent structure and decent,
you've got to critically, that's right. You've got to critically evaluate your culture. The benefits of this are, from the government's perspective and the advocates for this structure, is that, well-being, retention, and therefore profit of businesses where there is an element of employee ownership tend to be higher than those other in private hands. Those are the headline stats that you will often see if you do some online research into these. But it is very important that you have the right culture. If you've got a very autocratic style of management where the founder makes all the decisions, really wants to retain control, then if you are looking at this as an exit, you have to think, well, is it really for me? There's a lot of change culture that we need to undertake, a lot of change management. We'd probably have to bring people into the business. They would take time to establish and bed in. So are you therefore better off looking at a trade sale? Probably yes. And similarly, because of there is elasticity around valuation. But, you and I have seen, Nicky, certainly over the last sort of 18 months, 2 years, where there have been some unbelievable multiples that people have been prepared to pay for businesses. And you may well get more money up front proceeding down that route. It really does depend. If you don't have huge cash reserves to extract, or substantial cash reserves to extract on day one, and you're unable to get some bank funding to support this structure, do you really want to take a 5 or 10 year or 3 year earnout and hope that you're going to get the benefit that way?
Indeed. And I've seen a lot at the moment. There's a huge demand for amalgamating multiple companies with lots of synergies, because they're looking at economies of scale, consolidating all the back office functions, for example, making sure there's cross-selling between them all, because at the moment it's getting increasingly expensive for an SME to operate on its own. So if it then did go in a trade sale to a larger group, yes, you might get more money and you might have more certainty, one, of then getting that money, and secondly, of the business still being around in 5-10 years, potentially.
That's absolutely right. I mean, it's interesting to note that currently, the Employee Ownership Association stats are that there's over 1,000 businesses in the UK which are now employee owned through this type of structure. And as I said, it is sort of sector agnostic, in the sense that you've got some nationally renowned high street retailers that are now employee owned. You've got, as I say, professional services firms, and as I say, everything from small IT, engineering businesses, and everything in between, really. So
there's no sectors that are barred from this. So, for example, like with EMI, there's certain sectors like accountants can't do those. So any sector would be able to do this.
Correct. And certainly in professional services, it's quite an attractive route, because quite often a bar to sale on a professional service firm is the offset of the goodwill price that you would want for the run-off PI cover that you'd have to pay over the next 6 years. So that often is a barrier to certainly in legal profession.
Where the goodwill is being devalued a lot at the moment, it can be another option. We've got 5 minutes left, so we can quickly bash out a few more questions, and there's one that has come in from Pete. Would a trade sales price also suffer if it's owner dependent or have a longer earnout? I'm not sure if that's a question for you or me there, Stuart.
Sounds like a valuation one there, Nikki.
Yeah, so I'm happy to pick that one up. But yes, if it is owner dependent, I think on both ways, on the success of whether it's a trade sale or if it's an EOT, could suffer. So either option, you still should be looking at trying to make sure you have proper succession planning and a decent management team in place, so that one, if it's an external sale, you can get a much better earn out and a higher multiple potentially. And for the EOT, it's going to fail if you don't have.
When it comes to the EOT, it's very important that there are these change of control rules, that there has to be a bona fide change of control, not just at share level, but also in terms of direction and board of the trade.
You can't just feel like, oh, I'm going to partially cash out and get this great tax benefit of exiting it that way, but then still control it all. You're not allowed to control that company anymore.
That's correct.
You can come back and be a consultant or do some reduced job.
You can continue to sit on the board as long as you're not controlling that board, for example.
Precisely. You're no longer the boss. Brilliant. So as said at the top, you've done a lot of these, and I know you're saying about that you've got before this, you've got another 2 launching next week. What would you say to any business owners out there that are considering this? What is your top tip that you would want them to have as a takeaway for today?
Think about it. Think critically about your business. First of all, go and do some research. The Employee Ownership Association is a fantastic resource. There's lots of information there, not just about the hard, cold transaction number, but also the importance of change management, the importance of culture, how you involve how you create that conduit between employees and the trust board. Do go and take advice early from someone experienced in this field, and carry out an audit. If this is a route to exit you are considering, you shouldn't, without understanding the detail of the rules and how they can apply, or how you might not qualify under this route, before you can consider that, you need to understand the detail. And therefore, by all means, I'll happily have conversations with you. There are tax specialists that I've worked with before that can also assist. So that really is the plan.
Yeah. Just for a plug, so at Gorringe we've got a couple of tax specialists that can do these as well, in conjunction with Stuart as well. So if you want a joint team, but obviously it depends on the sector where you are, etc. But
get a handle on the rules. Get a handle on the rules, how they apply to you, and consider that critically alongside your other routes to exit.
Fantastic. Thank you so much, Stuart. That was really good. So anyone we've certainly done our job. Anyone that didn't know anything about OET, they should know quite a lot by now. And those that just had an inkling, hopefully they'll feel a bit more confident in the direction about whether this could be the right or wrong thing for their business. So if you want to, you will want to contact Stuart. So if you're watching this on LinkedIn, you'll see that Stuart's linked into here, so you can contact him directly or direct message him on LinkedIn, or you can call through to the Reading Clark's legal office, and that's where he is at the moment. He will be there to be able to assist you if you are watching through YouTube and you're not on LinkedIn. But thank you so much. That was really, really good. And sure, I've known Stuart for a lot of years, so I know that he does know what he's talking about. So please do contact him for anything OET related. Thank you very much, Stuart.
Thank you so much, Nikki. Thank you for having me.
Pleasure. So next week, usual regular time. What we are end of month, so it's our succession planning one. So which fits in for this as well, but we're being a bit more specific. It's with Nigel Elks. We will be talking about what the market is like at the moment for trade sales, which, considering the forecast of the economy, is actually still very buoyant for acquisitions. So we'll be talking about that and other relevant things. So please do tune in for that. But for now, thank you very much. Have a lovely weekend. And don't spend all your income tax cuts too quickly.
Bye, Nikki.
Yeah.
Cheerio. Bye-bye.